In a shocking and urgent move, the Trump administration has just done something we've never seen before. The U.S. Treasury's Undersecretary, Scott Bessant, is now formally demanding that a major global lender, the Asian Development Bank, immediately stop all loans to China. That's right. Washington is pulling emergency levers to cut off China's financial lifelines. This isn't just political drama. It's a direct hit on China's access to development funding, money that Beijing has used for years to build its global influence. Now, the U.S. wants to shut that pipeline down. Why? Because behind the scenes, the White House is in financial panic mode, the dollar is under stress, inflation is climbing, and China is taking a stronger hold on global trade. The U.S. feels cornered. This is Trump's counterattack. The administration is going all in with aggressive moves, while confidence in U.S. Treasury bonds is falling fast and interest rates are climbing to dangerous levels. Meanwhile, China is gaining ground. With lower borrowing costs, Beijing can access cheaper and more abundant funds, a major edge over the United States. So what's Washington's new plan? Force global banks to stop lending to China, even though China currently has a better credit rating than the United States. Is this just a warning or the start of something much bigger? Quick reminder, don't forget to subscribe to the channel. Thanks. Trump has gone back to one of his favorite strategies, tariffs. He just raised taxes on over $600 billion worth of Chinese imports. Some items now face staggering tariffs as high as 145%. The message was clear. Trump wants to punish China and push U.S. companies to bring manufacturing back home. But things didn't go as planned. Instead of hurting China, the move shook up global markets. Yields on U.S. government bonds spiked, foreign investors started pulling out, and faith in America's economic stability began to crack. For decades, the world saw U.S. Treasury bonds as one of the safest places to park money. Now, even that trust is slipping. Trump thought tariffs would bring back jobs, factories, and negotiating power. But here's the harsh reality. You can't win a global trade war if your own economy is collapsing. And if tariffs aren't working, what's next? When the tariffs failed to deliver, Trump moved to Plan B, more corporate tax cuts. Back in 2017, his team cut the corporate tax rate from 35% to 21%. Now he's pushing to slash it even further, down to just 15%. On paper, that sounds like a win for business. Lower taxes, more room to grow. Companies like Tesla and Foxconn even hinted at new investments in the U.S. But here's the issue. It's extremely expensive. These cuts could cost the government nearly $9 trillion over the next decade, about $900 billion per year in lost revenue. So where will that money come from? Borrowing. To cover the gap, the government needs to sell even more Treasury bonds. But there's a problem. Investors aren't exactly eager to buy U.S. debt right now. And if lenders demand higher interest rates, borrowing becomes even more costly. It's a dangerous cycle. More debt leads to higher borrowing costs, which then leads to even more debt. Trump is betting that tax cuts will trigger enough growth to manage the debt. But what if that bet is wrong? There's one major obstacle in Trump's path, China. So how do you take China out of the picture? That's the real challenge. But first, let's look at why the U.S. bond market is in chaos. In the past, America could take on huge debt because global investors trusted U.S. bonds. Now that trust is fading. In March, the yield on 10-year Treasury bonds spiked to 4.5%, and 30-year yields climbed to 5.1%. That set off alarm bells across global markets, already nervous about a recession. Japan, one of the biggest holders of U.S. debt, with over $1 trillion, started quietly selling off treasuries. Other foreign investors followed. At a recent auction, foreign demand for 5-year U.S. notes dropped from 70% to just 64%. That might not seem huge, but in the bond world, it's a major red flag. As yields rise, borrowing becomes more expensive. That affects everything. Mortgages go up, credit dries up, and companies pull back on hiring or investing. So why are investors backing away? The answer is simple: fear. Trump's unpredictable trade policies, combined with massive tax cuts and exploding deficits, are making the U.S. look like a risky bet. And when investor confidence drops, the cost of borrowing goes up for everyone. So what happens if the U.S. can't borrow easily anymore? What if the bond market pushes back? Here's the twist. While America's bond market is struggling, China's is gaining momentum. Yields on China's 10-year bonds recently fell below 1.7%, even lower than Japan's. That's extremely low, giving China the ability to borrow at cheaper rates than the U.S. Why? Because even during a trade war, investors see China as more stable. Beijing acted fast to calm markets, issuing long-term bonds and investing heavily in infrastructure and energy. Investors from Europe, the Middle East, and even the United States have been pouring in. Now China looks like a safer and more attractive place for investment. That's the opposite of what Trump wanted. The trade war was meant to hurt China. Instead, it made China look more reliable in the eyes of global investors. Even worse, China now has access to cheaper money. Money it can use to build more factories, fund new tech, and support allies. While the United States struggles under its own growing debt. For decades, American power wasn't just about industry, it was about trust. Trust in the U.S. government, the markets, and leadership. But that trust is breaking down. America is walking a dangerous path: rising debt, higher interest rates, and falling global influence. And if the world loses faith in the U.S. bond market, the damage won't stop at Wall Street. It could mean less money for defense, healthcare, and infrastructure. It could lead to higher inflation, slower growth, and a shrinking role on the world stage. Trump's policies may look bold, but boldness without stability is just noise. The real question isn't whether the U.S. can win another trade war, it's whether it can afford to keep fighting abroad while losing the economic war at home. With tariffs failing and the bond market under strain, the Trump administration is now opening a new front in its economic war, targeting multilateral banks. At the center of this strategy is the Asian Development Bank, or ADB, one of Asia's biggest infrastructure lenders. The White House, led by economic advisor Scott Bessant, is now pushing to have China removed from the list of eligible borrowers. Why? Because the United States believes China is using low-interest ADB loans to quietly expand its influence in developing nations, sometimes using money that comes from U.S. allies. China can borrow from the ADB at rates even lower than what the United States pays on Treasury bonds. Then it uses that cheap money to fund projects in countries that are desperate for infrastructure, especially in places where the